Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage spreads, which are now at the best level of the year, and how better spreads can positively impact mortgage rates. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
It's wonderful to have you here. Okay, we have so much to talk about. Do you want to talk about Waller first, or you want to talk about mortgage spreads?
Well, let's talk about mortgage spreads.
Okay.
So, it's Thursday morning and mortgage spreads, this is like the lowest print in many years, right? And, it's one of these topics that, I always love to talk about, but, I think it's so important and it's something that not a lot of people in the industry know. So we were really trying to harp on this over the last 2 years. And for everybody that follows the tracker, there's a better spot now on HousingWire's website that could actually, you could get to the tracker faster. I know a lot of people were looking for that. And, we always talk about the spreads every single week. We give everyone updates. But because the spreads have improved so much, we're starting to get to the point to where we could possibly talk about sub 6% mortgage rates. Something I haven't really been able to talk about. I mean, even though the low end forecast for me for the last 2 years have been, or this year and last year was 5.75, because I needed to see the spreads get better, and the spreads getting better looks normal at this period. It's a very positive trend because you don't need the 10-year yield to get to the Gandalf line in 2023. That was 3.37%. And mortgage rates got to 6% with a 3.37% 10-year. We are so far from that. So hopefully that gives you all some perspective that if the spreads didn't improve, we are nowhere, close to a 6%, because we need the 10-year yield to, go roughly almost 80, 90 basis points lower for this to work. So very, very positive thing this year in 2025.
Okay, so I have a couple of questions. First off, you go over this every week in the housing market tracker that we do on the weekend, and you talk about where the spreads are and where they would be if they hadn't improved, where they would be if it was normal. So maybe walk us through that right now. Like, is this getting to where spreads normally are, coming off of that really big level?
So we're getting closer to 2%. Now, this is a very nerdy discussion. What a lot of people think about is mortgage spreads are normally between 160 and 180. That's true in recent history. But if you go back decades, we've had spreads 1.5% and lower. We've had spreads 50 to 1.5% in the 1970s, as high as 2.3%, even with inflation. But recent history, 1.6 to 1.0. My forecast for this year was for spreads to get better, just 27 to 41 basis points, using how we track the spreads on a 2.54 average of last year. So we're getting close to that level. And it's just like shocking people, because a lot of people were told that mortgage spreads will never go lower ever again in the history of America because the Federal Reserve, it needs to buy mortgage-backed securities, and without them buying back mortgage-backed securities, it's not going to happen. And the other impact is that they're going to, sell mortgage-backed securities, so mortgage rates will go up to 8, 9, 10%. These are all anti-central bank people, by the way. But in this case, if you study the history of spreads, what's occurring right now makes sense. It made sense going into 2024. It made sense going into 2025. So such a positive story, because the best example I could give, in 2023, we only got to, I think, 5.99% for like a day, but it needed a lot of people were worried about the Silicon Valley banking crisis, recession, and everything. And the 10-year yield got to the Gandalf line. And I'm telling everybody, we're not going to break this. We're not going to break this. And everyone's like, we're going to break this. I was like, no, we shouldn't. And things reversed up higher. So a year for the spreads.
A year for the spreads. Okay, so looking at the specific places they're going, because when you say, I mean, we would be thrilled just to get to 6%, right? Because that is the level that you're like, this is where we see housing demand. You just wrote an article about that yesterday. But if it could go below 6%, I feel like you would be drawing a lot of people off the sidelines just from a like, oh, so many more people would be qualified. Lots more people are like, yes, I'm willing to jump in.
I don't ever talk about sub 6% rates because a lot of things have to happen for that. Some of those things are in works. You know, a great case is for a reversal is that the inflation data starts to pick up and the economic data improves, which can send yields higher.
Right.
But when yields run higher, the spreads get better now. So it's a positive in that sense that the days where we see these kind of big moves in the 10-year yield, the damage was limited, you know. So, you know, the builders have been able to keep their new home sales levels at 2019 for a long time because they work in a sub 6% mortgage rate. So you obviously got buyers that are in there to keep sales that high versus the existing home sales market. But I'm only going about what I've seen in the last 2 years is that the duration of rates going towards 6 gets things a little bit more. And again, we're working from the lowest levels of sales ever. It's the third calendar year. And we don't have underwater mortgages. We don't have credit getting hit or tightened in any meaningful fashion or anything like that. You know, so as Scott Bassett said, you want to unfreeze the housing market, right? So you need kind of the lower rates with duration. The duration is the key. And every time we've gotten near this level, things reversed up higher. So it's just so fascinating because with the spreads being where it is, it's been a while. It has been a while for everyone to see good spreads. And for a lot of people, they still don't know what we're talking about.
No, it's true. Like whenever you speak, you ask, "Hey, how many people here know about mortgage spreads or know what I'm talking about?" And just a few hands. I mean, we'll be in a ballroom with hundreds of people, and it's like less than six will raise their hands. So I do think this is confusing. It's also confusing to people what moves these. So you mentioned the Silicon Valley banking crisis.
On a negative side, you know, market volatility, but when rates rise up, I mean, the simple way is this EPO risk, early payoff risk. You investors need to be compensated, you know, for this kind of investment because, you know, as mortgage rates go up, I mean, just a very quick, simple, you paid X amount for a mortgage rate. If it's likely to get refinanced sooner, you lose that money. So you need compensation. When the market gets volatile, you know, spreads get larger. We saw that with the Godzilla tariffs, but the spreads only getting worse was only 20 to 25 basis points. 2023, the spreads got really bad after the Silicon Valley banking crisis. But, you know, in this case, you know, you're looking at, if we had the Silicon Valley banking spreads, you're looking at, you know, 70, 75 basis points higher. But if you have normal spreads right now, you're sub 6% today, right now,
It's
with the
crazy.
10-year yield where it's at. And it makes some of the things a little bit more workable on the modeling side.
I would encourage everyone follow the tracker because really that's what you're looking at all the time. Look, it's one of those data points that you're doing, and we are about to unveil an easier way for people to get to the housing market tracker. So stay tuned for that, you guys.
Yes, and always remember the tracker article is to show you how we track everything on the national side. But our bread and butter are states, cities, zip codes, and they're done in a much more prolific way. We give you a taste of, you know, the chart daddy breakfast, you know, that we have. We give you an idea of what to think about in national economics because housing and economic cycles tend to stay similar. But if you really, really want the juicy stuff, Altos Research, you go to the website, you could get a free zip code and just to see how it is. And we'll be doing our webinar on August 20th. You can get a registration link where I kind of talk about the how we track the inventory demand data. And remember, we're not what we call third-party regurgitators. We don't take like another company and just give you the basic information and say this. We like to show you multiple data line sets and how we interpreted what could happen between, the economic cycle, right? That's my thing. I'm more of an economic cycle person first. So in that sense, it becomes a little bit more clear, but you can break it down to your zip code. This is why Wall Street likes us, real estate investors and kind of prolific realtors. We really give it because it gives you a little bit more clarity. And especially in areas where, it's becoming more of a buyer's market, when your sellers get to see it, they're like, oh, okay. Because we all know sellers sometimes have a false sense of reality.
Okay, so now let's talk about the Fed. We did a whole episode yesterday about mutiny at the Fed. And after we got off, not that long after we got off, we had another Fed member talk about, yes, joining the we should be cutting rates chorus. So tell us about that. Tell us the latest, because of course we would love to see some rate cuts there.
So the interesting part is, after we were done with our podcast yesterday, another Fed governor came out and kind of said something more dovish. So you're starting to run the numbers here, and there's a lot of dissents coming in. But today's news is that Chris Waller is now leading in charge, and we're like, oh my God, everybody was like, you're having the week. And I'm showing the video of me DJing, and getting smoke thrown at me. And I'm like, this is great. If I could get Waller and Neil Dutta, we're throwing a party. We're throwing a chart daddy nerd party, so that's very good. And that to me makes it seem that Bassett is, really telling Trump, hey, listen, this is the best guy, because not only was he advocating for rate cuts before any of this stuff, he's got a more coherent way of maybe rallying the troops together, in that context. So I think that's a positive. We'll see what happens, and it should happen soon. Right? Who knows? Maybe by the time this podcast ends, we might know who it is. But there's a lot going on, and to me, it's again. Remember, 2 months ago when Jerome Powell said that, hey, it's really hard for people to find jobs. Remember, it's a really tough market for people to find jobs, and we're like, wow, he's just flat out admitting it. Well, now that the labor market isn't as strong as they thought. Waller was always ahead of that. That's the thing. I think Bassett is telling her, hey, listen, he knows how to, get the troops. And what Waller would be saying, hey, listen, we've had really negative revisions, and we're not seeing hirings, and it's very, very narrow right now. And of course, when manufacturing and residential, there's all these things that he was right. And trust me, the Fed people do not want to be late. If they see something breaking, they turn on a dime. All right. And because of that, I think he's a little bit more careful. Where Kevin Warsh, everyone hates Kevin Warsh, so you can't rile him up. Kevin Hassett is better than Warsh, but he's still a yes man. So it is positive that, his name is out there, because if you get somebody like that is already dissented against Powell, and he is on the opposite side of him, he could get the troops going. So hopefully that's the case. Hopefully by the time this podcast airs, they announce him. So we'll see.
Announce him as the next Fed president, which would make him the shadow Fed president, which would, then everybody starts listening to him because he's the one who's going to be setting.
I think after that Jaws report, man, Powell's just losing more and more, validity on that. And it was the tone and dismissiveness in the last Fed. Remember I said if Trump understood what Powell was doing here, he'd probably be fuming, because that's how that Fed presser was. So again, we'll see, if the economic data firms up and inflation firms up, we have a whole different kind of discussion here. But for now, the mortgage spreads are good. Waller is coming here. Maybe Neil Dutta gets, I'm having a good week, in that sense.
So we got jobless claims today. What do you make of those?
So this is interesting. When we look at jobless claims, there's kind of two big data lines. There's the initial claims and there's the continuing claims. The initial claims picked up a little bit, but the 4-week moving average and headline is still very low. The continuing claims, on the other hand, had a big pop. It's at a 3-year high. And what does that mean? Is that it's not a great labor market, like Powell said months ago. If you're looking for a job, tough. It's really hard, and the continuing claims are people basically, who are still filing for unemployment benefits, but past kind of like 2 weeks. So with that elevated, it just shows what we've talked about. The labor market has been getting softer for some time now. It's 19 months. Softening is not breaking. I don't want to be right. I don't want the Fed to wait till this breaks, right? Because a lot of people say, well, it's breaking. Look how low the job creation was. And you see multiple sectors falling. They can change. And this is why it was encouraging to have a bunch of Fed people say, hey, boy, that labor, it's good in that sense, because now when the Jackson Hole meeting comes, Powell can basically talk about it. But we have to always remember, all these discussions that we're having right now is just neutral policy, how to get to neutral. We're not talking about an accommodative or anything like that. We're just trying to get, now I know Trump wants 3% rate cuts and, whatever, but we're just talking here is, how do you get to an accommodative policy easier? If you start getting into how do you get to a neutral policy easier? But if you start getting to an accommodative policy, then this whole discussion, we open another box, right? And I'm not opening that box until until they say, Fed policy needs to be an accommodative stance, not a neutral stance. Right now, they're modestly restrictive, right? So we said this in 2022, they will stay as restrictive as possible until the labor market breaks. We're right at that thing where people can make that statement, but I'm hoping that this is the turn. If the economic data gets better, love it. I'll take that 24/7. But at least now everyone's in the playing field right now on this. And the more conversation, the better, rather than having Powell go up there and say, hey, listen, I could be raising rates right now, and just kind of having that tone. And what a change. Talk about what a flip in just a few days, where people are like, oh, he sounded very hawkish, and it doesn't, and now all of a sudden everyone's, oh, wow, the labor market is not as good as people think.
It reminds me that when you gave your presentation at the gathering, you're like, everything's changed in the housing market. And now we're looking forward to your presentation at the HousingWire IMB Summit in October. And you, the tentative name is What the Bleep is Going On with the Housing Market. And I encourage everyone, y'all should be there, because it's going to be an incredible talk by Logan, and he's going to be accessible. You can ask him questions. You can talk to him in the cocktail party, and get all his Chart Daddy download, whatever there. So I'm really looking forward to that session, and it's going to the market, everything's going to change between now and then. But I know you are going to be absolutely on top of it, and it will be a very fresh conversation.
Did you get a little Texas on me when you said y'all?
Oh, did I? I don't know. It just comes out.
You didn't get Texas on me when I was on that bull at Billy Bob's. You're just sitting there laughing at me because I look funny.
Laughing at you.
Yes.
We saw people bull riding. That was a really fun. That was a fun event. Yes. Okay. Sometimes the Texas just comes out. I don't even mean to. So anyway, everybody look at the IMB Summit. Come if you can. It's going to be amazing. Logan, thank you for keeping us up to date on everything. Can't wait to talk to you again soon. And who knows what will happen between here and there.
Y'all better watch out, because we might get a mutiny on our hands.
I apologize in advance for that. Okay. Thanks, Logan.